let's cut into a press conference from Cabinet of Economic Affairs. They are addressing a press conference on Q3 GDP numbers.
And part of it is either due to or because either due to the FPI flows or FPI outflows or a consequence of this. So there is a two-way relationship between the two. And as we speak today, we notice that the US stock market is significantly down, and the Indian market today has reflected that as well. But as a recent commentator, one of the long-standing observers of the Indian market, Mr. Chris Wood of Jefferies, earlier he used to be in CLSA, and he has said that from a long-term perspective, he continues to remain very positive on Indian stocks. And the growth numbers we have seen, including the revisions to previous years, validates the point he makes, which is about the long-term attractiveness of the Indian market at this stage, notwithstanding recent volatility, which is partly driven by global developments and also partly driven by stellar gains of the previous years. Next slide, please. The central bank in the last 2 months or so has been unwinding some of its unintended monetary tightening and also credit tightening that happened in the course of the current financial year. In fact, starting from the previous financial year, not only have we witnessed a reduction in the repo rate and the cash reserve ratio and also the higher risk weights, which were mandated in November 2023 when uncollateralized, unsecured consumer loans where risk weights were restored to the pre-COVID levels. But now that these loans have growth rates have come down, RBI has withdrawn the increase in risk weights mandated in November 2023. So the non-food credit growth, which was 17.1% in FY23, at a peak is now at 12.4%. But considering the nominal GDP growth of 9.9% projected this year and 12% last year, non-food credit growth is not trailing nominal GDP growth, and that's a good sign. Next slide, please. In terms of outlook for capital formation, which is what we turn to next, import of capital goods has been steadily rising, and that is the share of capital goods in total imports is about 20% compared to a figure of around 17 to 18% in FY22 and FY23. And the production of infrastructure and capital goods in the 3 quarters of the financial year compared to the previous financial years, whether it is capital goods or infra construction goods, you can see a steadily rising trend, which augurs well also for capital formation. Next slide, please. Private investment intentions after a dip in the first quarter due to election-related uncertainties in India, and therefore they are again picking up in Q2 and Q3, as this chart very clearly demonstrates. This is the value of new projects announced by the private sector. Next slide, please. And also, if you look at the labor market, unemployment rate is down to around 6%. And the labor force participation rate is comfortably above 50%. And we are seeing a steadily rising net payroll additions based on EPFO records. So after a dip in the first 2 quarters of the financial year, this is also in a way consistent with the improvement we are seeing in the GDP trajectory and the projected implied growth rate